Good afternoon and welcome to today's program, Straightforward Answers to Your Questions about Fixed Income. I'm Stacy Murchison, Chief Marketing Officer at Chevy Chase Trust. For nearly all of the past decade, no one was terribly interested in talking about fixed income investing or bonds at all. Equity investing was at the top of everyone's minds. But times have changed. From 2022's inflation spike to a high of 9.1%, to the recent collapse of several banks, and last week's ninth consecutive Fed funds rate hike, our attention has shifted considerably. And now interest rate moves, the Fed's actions, and fixed income investing have the spotlight. At Chevy Chase Trust, we are committed to providing clients with a customized approach to wealth management. Part of that customization can be seen in one of our strongest differentiators, which is our expertise in building client portfolios with individual bonds. Today, two of our senior fixed income managers, Craig Pernick and Carlton Davis, are here to address some of the most vexing questions facing investors. Craig is Senior Managing Director and Head of Fixed Income at Chevy Chase Trust, with more than 40 years of experience working with fixed income assets. His right-hand man is Carlton Davis, Director, Fixed Income Trader, and Portfolio Manager, with 13 years of experience and now in his second stint with Chevy Chase Trust. We will begin our program with a series of questions for Craig and then Carlton. We received many questions for the fixed income experts ahead of today's program, so we've gone ahead and incorporated the answers into our presentation. Therefore, we should cover close to all of your inquiries. For those of you who posed more specific questions, Craig and Carlton will get back to you privately. For those who may have a question during today's presentation, feel free to type it into the Q&A box using the button at the bottom of your screens. Craig and Carlton will get back to you with answers. So at this point, I'd like to welcome Craig Pernick.
Hi, Stacy. Always happy to talk fixed income. So great to be here.
Great. Let's get started with our first question. Craig, given the recent news about the Silicon Valley Bank, Signature Bank, and Credit Suisse failures, please begin with an overview of what's happened, the reaction of interest rates in the bond market, and describe the safeguards at Chevy Chase Trust for protecting client assets.
Top of everyone's mind, we have certainly seen significant events and effects from this current banking crisis. I believe that other than COVID, this is the most important market issue since the 2008-2009 great financial crisis. Bank crises almost always lead to economic slowdowns because troubled banks extend less credit. We expect the recent regional bank failures and deposit withdrawals to make regional banks more cautious about lending, with important implications for the economy. Given this crisis, we have seen a dramatic shift in Federal Reserve expected rate actions. We've seen a tightening of the banking system, a significant decline of all interest rates, and increased bond volatility. Just to recap, 3 weeks ago, due to a sudden increase in deposit outflows, which is the classic run on the bank, and a failed attempt to raise equity, Silicon Valley Bank was shut down by U.S. regulators. This marked the largest bank failure since the 2008 financial crisis. Silicon Valley Bank ultimately failed because of an asset liability matching problem. They had overnight liabilities, which are the deposits, and they matched those with long-term assets, which are, they bought U.S. treasuries. Those treasuries lost value as interest rates rose. When rates go up, prices go down, inverse relationship, very important to understand. 94% of deposits were uninsured above the FDIC 250,000 limit. However, understanding the implications of depositors potentially losing money, the FDIC stepped in to fully guarantee all depositor assets above that 250. This did not and does not provide any protection to equity investors or bondholders, and any costs related to guarantees will be covered by the Deposit Insurance Fund, a fund supported by required payments from all banks. We see that just this week on Monday, Silicon Valley Bank was acquired by First Citizens Bank. To provide additional support, the Fed has created the Bank Term Funding Program, which provides additional funding to help assure banks can meet the needs of their depositors. While making no definitive commitment, Treasury Chair Yellen has said the U.S. government could repeat their actions to protect bank depositors if smaller lenders and other banks are threatened. I think it's important to understand the bond market's reaction to this banking crisis. We put together a graph here which shows how interest rates have responded to the banking crisis. You can note the extreme decline in rates and the change in the shape of the yield curve as the market prices in tighter credit conditions. So the gray line is the graph before chart, the date before, right before the crises, and the green line is where rates have moved 3 weeks following. Note the nearly 100 basis point decline in rates in many parts of the curve. All rates are lower, and short-term rates fell more dramatically than long-term rates. That's the left side of the chart, 1 year out to 30 years. And I will note, I said 100 basis points. When I say 100 basis points, that's 1%. So a 0.5% would be 50 basis points or 0.5%. This size and speed of a move is not often seen, and usually the bond market's way of saying recession risk is potentially and now more elevated. I'll discuss some of these points later in the discussion. This shows the bond market volatility having increased dramatically, and bond markets are reacting more than equity markets. Currently, equity markets seem to be more focused on the benefits of lower rates than the risks in the banking system. Bonds have exhibited extreme volatility as market participants quickly realize the ramification of tighter credit conditions. After a long period of decline since the great global financial crisis, the MOVE index, which measures volatility in treasury bond markets, surged to a near record high of 199 on March 15th. That's that spike here on the far right. And I'm sorry I don't have a little circle to move there, but I think you can see it. And remains near some of its highest levels at 150. The 5-year average is 75. We expect this volatility to remain elevated in the near term. We have received calls from clients looking to better understand client asset protection at Chevy Chase Trust. We have several operational safeguards in place. Chevy Chase Trust is held to a fiduciary standard and must act in the best interest of its clients at all times. Chevy Chase Trust and its sub-custodian segregates all client assets from Chevy Chase Trust general assets. Client assets are not subject to any claims of general creditors of Chevy Chase Trust. Additionally, while we are not a bank and FDIC protections are not applicable, and we get that question a lot, all client cash is held in the BlackRock Liquidity Fed Fund. This is a money market fund that only invests in U.S. government-backed securities. It complies with the 2016 money market reforms, is SEC registered, and cannot restrict withdrawals. It is one of the largest money market funds by size with $120 billion in assets. The current yield today is 4.6%.
Recognizing that the recent banking crisis may have altered the Fed's path this year, can you describe for us where we've been with rates and inflation during the last few years and the role the Fed has played that has led us to where we are today?
While interest rates are dramatically off their recent highs due to the banking industry turmoil, I think it's really important to look at significant volatility in rates over the past several years. U.S. interest rates are directly correlated to inflation levels. The rise in inflation is largely connected to U.S. fiscal and monetary policies designed to combat COVID recession over the past 3 years. With the U.S. economy essentially shut down by COVID, desperate measures were called for to stabilize our economy and support a rebound. There are two main tools which make up U.S. economic policies: monetary and fiscal. U.S. monetary policies are the positions laid down by the Federal Reserve. U.S. fiscal policies are government spending and tax policies. This chart shows monetary policy side. The Federal Reserve began an easy money policy. So you may have heard that expression before, but easy money is when the Fed allows money to build up in the banking system. The Fed essentially set rates to 0% during the crisis, COVID crisis, to allow for easy access to money. This chart shows M2 money supply. This is the U.S. Federal Reserve's estimate of the total money supply including all of the cash people have on hand, plus all of the money deposited in checking accounts, saving accounts, and other short-term saving vehicles. This is really how liquid consumers feel. Rapid M2 growth can be a warning sign of inflation. This chart shows just how dramatic the increase in money supply was during the pandemic. You will note a recent decline due to the bank crisis as cash has left banks and moved to institutional money markets, which are not included in M2. So additionally, the Federal Reserve embarked on a massive round of quantitative easing. So you may have heard QE, quantitative easing, QE. QE is a Fed tool meant to increase liquidity for consumers, businesses, and investors. QE involved increasing the Federal Reserve balance sheet as the Fed bought trillions of dollars of securities in the secondary market. They essentially became the buyer of last resort and supported bond markets and investors. The Fed balance sheet is simply a statement listing their assets and liabilities of the Federal Reserve System. This chart is equally impressive and shows the exponential growth of the Fed balance sheet as the Fed purchased bonds to support the market and only now is beginning to unwind these positions. So the red arrow shows that huge exponential growth of the balance sheet. The Fed is currently, though, allowing 95 billion per month of bonds to mature without being repurchased. This is effectively a tightening move, or the reverse QT, quantitative tightening. So we talked about the monetary side. On the fiscal side, US lawmakers approved trillions of dollars of stimulus plans, including names we've come to know, the CARES Act and the American Rescue Plan Act. These policies were designed to provide liquidity and confidence to consumers, businesses, and investors, similar goals to the quantitative easing we just mentioned. The total debt outstanding, more than $30 trillion, represents the face amount of marketable and non-marketable securities currently outstanding. We can see the steady growth over the years as US deficit spending has been financed by additional debt. Dramatic increase can be seen during the 2008-2009 financial crisis and the COVID crisis, that red arrow. Economic slowdowns in government spending led to significant debt level increases. In the US today, 50% of all government debt is set to mature in the next 3 years or less. Current debt is much more expensive than previously anticipated. In a prior report, the CBO, Congressional Budget Office, forecasted interest rates for this year and next year at 2% and 2.2%, well below current actual rates. There's a significant disconnect between forecasted rates and actual rates. Debt is costing us much more than the CBO forecast. The interest expense on US public debt rose to $783 billion over the past year, a record high. If it continues to increase at the current pace, it will soon be the largest line item in the federal budget, surpassing Social Security. Now we are on the flip side of the coin. These types of accommodating policies have contributed to a significant rise in inflation. As opposed to how the Federal Reserve lowered rates to stimulate the economy, over the past year, the Fed has been compelled by rising inflation and tight job markets to raise interest rates, a tool used to slow economic growth and control inflation. These significant increases, Stacy mentioned, 475 basis points, 9 increases, 4.75%, are a major reason for the weak equity and fixed income markets we experienced last year in 2022. As I noted earlier, all of these fiscal and monetary policies are in fact inflationary. So let's look at inflation. This chart shows the dramatic movements in inflation compounded by factors such as supply chain disruption, tight labor markets, the Ukraine-Russia war. The level of inflation we are seeing is the most extreme in 40 years. We're not in the late 70s and early 80s where inflation surged to 15%. That's that far left. Some of us remember those days due to easy monetary policy and energy disruptions. However, for the reasons we just discussed, the COVID crisis brought significant inflation, peaking at 9.1% in June of 2022. Right. So the gray line is Fed funds that we talked about, and you'll see that red arrow pointing to those increases. So The Federal Reserve is now attempting to unwind the actions to tame inflation, move towards a 2% inflation target. This chart shows the Fed funds rate, that gray line, and the 10-year Treasury rate, the green line. The 10-year is typically used as a benchmark when discussing interest rate movements. The Fed controls the Fed funds rate, but they have no control over longer rates, such as the 10-year Treasury. Those rates are driven by investors and expectations. While the future path may change given the banking crisis, in the past 12 months, the Fed raised 9 times, 475 basis. That is one of the most aggressive Fed tightenings in modern times. I think it's important to observe, this is important, that the Fed funds rate and the corresponding short-term rates in the market have risen to levels above the 10-year rate. This is known as inversion or an inverted yield curve. And that's that far right where the gray and the 4 3/4 is above the current Treasury.
Craig, that's a perfect segue into a discussion about the inverted yield curve. Please tell us what it is and why it matters to investors.
Yeah, this is probably number one right now in the questions that we're getting. Typically, long-term rates are above short-term rates. Okay, you're rewarded with a higher yield for accepting the risks associated with a longer period of unknowns. A lot more can happen in 10 years than 1 year. An inverted yield curve suggests that the near-term risk is riskier than the long-term. I think the question we're hearing most, and I mentioned, is cash and short-term rates are higher than long-term rates. Why don't we just hold cash or buy 1-year Treasury bills at 4.5%? On a cocktail party conversation, everyone's asking that. And there certainly is a place for 4.5% plus short-term money, bills, money markets. We mentioned our money market is a 4.7. We do buy those securities, but we don't believe that holding short-term cash investments is a winning long-term strategy. There's an opportunity cost. This is the opportunity lost to be able to buy the 10-year bond today at a higher yield than you might see in the future. And another way to look at this, if you buy the 1-year bond today at 4.5% and reinvest every year for the next 10 years at prevailing rates at the time, you will likely have a lower return than buying the 10-year now at 3.5%. The market believes the economy will be slowing, perhaps a recession. They believe the Fed will get inflation close to its target and will in fact begin to lower rates in the next year, leading, all rates lower. This chart shows when the curve has been inverted and how that coincides with recessions. So you look at 0 in the middle, and we circled the red areas where the 3-month Treasury moved below 0, okay? Many investors believe the inversion is a solid indicator of coming economic recession. This chart shows historically that 7 of the past 7 prior recessions have been preceded by a significant inversion. Now, at times there can be a lag of a year or more, so it's difficult to always attribute it, but we do see it. Market shocks, like the current banking crisis, can also cause extreme volatility in these curves. We are currently inverted on the far right here by 122 basis points, 1.22%. One of the deepest inversions we have experienced, as you can see, only back in the 80s, late 70s. Perhaps the current inversion is also signaling a recession, remains to be seen. We note that not all recessions are created equal, with the depth and the length of recessions varying wildly.
Craig, almost every day we're receiving inquiries about inflation expectations. What are the financial markets telling us about where inflation is headed?
So we showed the headline inflation chart. Let's take a more detailed look. So this graph shows headline inflation and core inflation. The green is the headline inflation that shows that 9.1 that we talked about, and the gray is the core inflation. The core excludes the more volatile food and energy component. The most recent CPI prints continue to show that inflation, though elevated and above the Fed's desired 2% level, is trending down. The Fed has the core mandate to control inflation and is very focused on current and anticipated levels. Fed Chair Powell has consistently noted that inflation levels are trending lower, which would be disinflation, but we are still well above their targets. As we mentioned, we believe the current banking crisis has accelerated this disinflation trend. But I think it's important to understand what are the real investable markets telling us about future inflation rates. So we like to look at Treasury futures and Treasury rates. We believe the markets are smart. They have a strong track record as an indicator of likely outcomes. These are real rates. So this is a spread between the 10-year Treasury bond, subtracting the yield on the 10-year tip, which is a Treasury inflation protected security. This is called the break-even rate. Essentially, the break-even rate is the implied rate of inflation that the market is expecting over the next 10 years. You will note the downward trending assumptions, and it currently shows assumed inflation over the next 10 years of 2.36%. This is elevated, but it's not so far off from the Fed's 2% target and well below the current level where we are of 6% or 5.5% on the core. So I mentioned tips, and I think people don't always understand tips, so I want to try to explain what a tip is and why it's important. So the tips is a Treasury inflation protection security. This is what would be called the real yield. So the real yield is the return above assumed inflation. So tips will always give you inflation plus a number over that inflation return. So if you buy a tip at 1%, since the security rate adjusts quarterly based on inflation, you will earn 1% above inflation. You can see that for many years, the markets were more or less what I like to call, and what we were always saying is broken. They were yielding zero or negative returns. So you can see that zero down in the middle there, and you can see a bunch of areas in the 2020, 21, 22 where we were negative, okay? With the Fed doing everything in its power to support the economy with artificially low rates, real returns disappeared. The median real return, however, over the last 30 years is 1.36%. With markets now more normalized, we have returned to a more attractive fixed income environment, with current real yields of approximately 1.15% off the recent highs, but mostly in line with historic norms, so better opportunity.
So given what we've discussed regarding inflation expectations, the inverted yield curve, Federal Reserve actions, and the banking crisis, what's Chevy Chase Trust's current view on interest rates in the economy?
We've said, and we believe, the banking crisis has significantly altered economic projections and accelerated the market and our projection of Fed rate cuts. We have a slide here that just shows how much that has changed. So this is look at clarity on rate direction. So this graph shows the dramatic adjustment lower in what the Fed funds rate market was expecting rates to be. So we're using futures. Prior to the banking crisis, that's the top gray line, the market was anticipating that the Fed would increase rates approximately 100 basis points, ending the terminal rate at around 5.75%, up from where they were at 4.5 and now 4.75. And they expected rate cuts possibly beginning in late 23. However, last week, the Fed said in their meeting, after their meeting, that recent developments are likely to result in tighter credit conditions and to weigh on economic activity, hiring, and inflation. In this context, last week, the Fed raised by 25 basis points. That was that ninth move, but they adjusted their forward posturing by saying that some additional rate increases might be appropriate, which was a change from a softening from language where they said ongoing increases prior. They also kept their maximum projected rate at 5.1% when it had been expected to go to 5.5%. However, if we look here at the green line and Fed fund futures, the current money trade says that the odds are currently, this is just up to date, 50-50 for a 25 basis point increase in May, but then cuts beginning much earlier and 75 basis points in cuts beginning in potentially July and ending 2023 at 4.25%, and then trending even lower to below 3.5%. 3.25% at the end of 24. It's important to note that the market and the Fed are at odds. The Fed fund futures, which we're looking at, believe rates will be lower than the Fed, which is currently forecasted in their dot plots. So the dot plot is the Fed members' forward estimate. The bond markets have a strong history of forecasting economic and policy direction. It remains, to be seen whether the bond markets or the Fed are correct this time. As I mentioned earlier, this move lower in rates and the prospect of lower rates has actually been supportive of equities, and equity volatility has been less than fixed income volatility. As seen in the last Fed action and statement, the Fed is trying to thread a needle, weighing rate increases to combat inflation and soften job markets versus rate cuts potentially needed to provide support during this new banking crisis. In our specific view, we expect volatility to remain relatively high in 23, but ultimately, we expect yields to fall as inflation declines and economic growth slows. While the yield curve is currently less inverted, we believe it is likely the yield curve will remain inverted in the near term with short-term rates above long-term rates. The odds that a recession will begin in 23 are certainly higher than they were 3 months ago. Companies in a wide swath of industries will have a more difficult time raising capital and will be forced to tighten their belts. Layoff announcements will increase, unemployment will likely rise, therefore consumers may become more reluctant to spend.
Okay, so with this in mind, what is the impact on investment allocations between stocks and bonds? Are you recommending any shifts?
Great question. At Chevy Chase Trust, each client's allocation strategy is customized to meet their unique needs. But the recent rise in interest rates has led to much being written in the press regarding the investment community 60-40 allocations. Everybody's heard this. The allocation 60-40 says that 60% goes into stocks, 40% go into bonds. And to get the best of both worlds, you have the 60-40, you get the growth potential for more volatile stocks, and you get the protection from the income of bonds. Given the significant rise in rates, there's been an increased interest in the role of bonds and investment strategies. That's why I'm sitting here today. As we noted, we're currently seeing some of the best levels in real returns in many years. When interest rates were held at artificially low levels by Fed actions during the pandemic, as we noted, the term TINA, T-I-N-A, there is no alternative, was frequently used to suggest that equities were the only investment vehicle of merit. This TINA mantra was just one of the factors that pushed equity prices higher over the past several years. But with higher rates today, TINA is dead and bonds are an attractive investment option. Some of the questions we received prior to today were specific about the ideal and correct asset allocation for my portfolio or a specific client portfolio. And we just, no two investors are the same. Each client should consult with their Chevy Chase Trust team to review the most appropriate equity and bond allocation targets.
Great, Craig. Thanks so much for sharing these insights. Let's turn to Carlton now. Welcome, Carlton.
Stacy, very nice to be here. I apologize. I may cough my way through this a little bit, just getting over a case of the flu, but happy to be here and happy to talk fixed income.
Okay, great, Carlton. The first question for you pertains to the process followed at Chevy Chase Trust to identify and then purchase bonds. What can you tell us about the steps that you take?
Sure. So Chevy Chase Trust's fixed income team employs a systematic process that starts with macroeconomic analysis and is followed by deep fundamental sector and security research. We manage risks associated with fixed income securities, including credit, interest rate risk, duration, and event risk by diversifying across geographies, sectors, industries, and maturities. We often seek value in unique bonds with special features such as call options, sinking funds, and project-specific linkages. We think it's also important to understand how Chevy Chase Trust purchases bonds for client accounts. We have a fiduciary duty to buy and sell bonds at the best possible prices. We do not own bonds for our own account. Our price is the client's price. The bond market is quite different than the equity market. we have to continually search for bonds that are often only available for a short period of time. We have to build portfolios with similar characteristics while using different bonds. We use cultivated relationships with the street. We speak daily to probably 20 plus different brokers. We can also buy from other managers just like ourselves. We want to be the buyer when other investors, such as mutual funds, are forced to sell at distressed lower prices. We prefer to be more opportunistic.
Okay, Carlton. So will you please talk about specific types of bonds that Chevy Chase Trust buys? Many people are unclear about the differences between municipal bonds and other types of bonds.
The fixed income team here at Chevy Chase Trust can purchase fixed income securities across many different markets. Our primary focus, though, is on investment-grade municipals and investment-grade corporate debt. So I'll start talking about municipals first. Municipal bonds are issued by state and local governments to support budgetary operations or finance specific projects. Federal tax law has been structured to lower the cost and facilitate the issuance of municipal bonds. Municipal issuers are able to issue tax-exempt debt, which is not subject to federal and in some cases, state taxes. Because the bonds are tax-exempt, they offer lower yields than taxable bonds like treasuries and corporates. We will talk more about the value of that tax exemption later. The security behind a municipal bond is either a general obligation, known as full faith and credit with taxing power, or a revenue bond with a specific stream of dedicated revenue. The proceeds of general obligation bonds are typically used for budgetary purposes, like providing K-12 education support, government payroll, facilities, libraries, roads, really any government operational need. A revenue bond, on the other hand, is tied to a very specific stream of revenue or project. So think the construction and maintenance of higher education, toll roads, utilities, and hospitals. There's a lot of debate in the muni market around whether a general obligation, which we call a GO, or a revenue bond is stronger. And honestly, it's not quite that simple, but we do see significant value in essential revenue bonds. So every time you pay your electricity bill, you flush your toilet, or you drive on a toll road, there's a good chance that that revenue is servicing debt. We look for bonds with strong sources of revenue that are in strong geographic markets. Not all accounts are identical. Every portfolio is going to look a little bit different. But if you look at our composite data for accounts buying tax-exempt municipals, you will see on this slide the current sector allocation on the left. So currently, it's 30% general obligation, 15% higher education, which is going to be typically universities, community colleges, 11% transportation, tolls, bridges, airports, 9% utilities, and 8% healthcare. The average rating, as you see on the left, if you kind of on the top right, not the left, is AA3, AA minus, which is very high quality. And you also see the top 10 state exposures on the bottom right. The highest exposure is to Maryland, with just over 16%, followed by Texas, New York, and Pennsylvania. On the taxable bond side, we noted our focus on investment-grade corporate debt. Corporate bonds are obligations of the companies that issue them. Unlike equities, which are more closely tied to the company's earnings expectations and dividend payouts, a corporate bond is dependent on the strength of the balance sheet. We typically invest in investment-grade corporate bonds rated BBB minus and above. These are names that you're pretty familiar with. So think Apple, Citibank, Coca-Cola, just to name a few. The investment-grade bond market is where large, established firms raise money to fund their operations. The sectors are the same as you'll see in an equity index, and they include technology, financials, utilities, energy, etc. The companies depend on internally generated cash flows to service the debt, so the fundamentals are essential. Our team conducts detailed credit analysis on all corporate and municipal bonds that we purchase. So let's take a look at the taxable composite breakdown. So on the left side, you'll see that our highest sector weight is to corporates industrial focus with 35%. followed by corporate financials with 32%, and taxable beauties at 20%. The average rating is currently A3, A-, as you'll see on the right, which is lower than our tax-exempt composite. Overall, the ratings distribution in municipals is higher than corporates. So there are more AA and AAA names in munis than there are in corporates. But when you really adjust it to the AA3 rating there and the A3 rating here are actually pretty similar once you adjust for that rating class.
So Carlton, we have another frequently asked question that's come up, and that's regarding credit spread. Can you please explain what is credit spread?
Sure, I think we should hop straight into a slide here. Credit spread is the additional yield an investor earns for purchasing a corporate bond instead of a U.S. Treasury. U.S. Treasury debt is considered to be very low risk, essentially the risk-free rate. A borrower with a stronger balance sheet and stronger credit metrics, such as Apple, which is rated AAA by Moody's, AA plus by S&P, so very, very high, is currently able to borrow 10-year money at approximately 0.75% or 75 basis points above the comparable 10-year Treasury. So the 10-year Treasury is at 3.5%. Apple can borrow at 3.5 plus the 75 basis points, which is going to be 4.25%. On the other hand, with something like Duke Energy, slightly weaker credit metrics, rated AA3 by Moody's and A by S&P, they currently would have to pay 150 basis points above that Treasury yield, so double the credit spread of Apple. The graph that we have up on the screen now shows the historical credit spread of a well-known investment grade credit index. Credit spreads are affected by various factors, including macroeconomic strength or weakness, buying and selling pressure, supply and demand. Credit spreads currently reflect the lowest net interest payments as a percentage of corporate revenues in 56 years. Take a look at what happened during the financial crisis. So you'll see the kind of spike there in 2008, 2009, the beginning days of COVID, the smaller spike there in March of 2020, and then the current SVB crisis. You see kind of way at the end there, the little jump that we currently see. Credit spreads blew out dramatically in 2008, 2009, and pretty dramatically in March of 2020, because nobody wanted to own any risk. They just wanted to own treasuries. But if you were brave enough to buy these bonds at wide spreads, you were rewarded handsomely when spreads contracted. So here we are again. You can see that the recent increase in credit spread has been spurred by the banking crisis. We have seen investment grade spreads widen from 120 basis points over treasuries to a peak of 163 basis points, but we have now rallied back down to 146 basis points over treasuries. We have seen bank and finance paper in general widen more significantly, on average from 150 to 250 basis points. We've also seen high yield spreads, which are going to be riskier, rise from 350 to 440 basis points. Although spreads have widened, they're not levels that we would consider indicative of significant stress. We have not yet aggressively added positions on this spread widening, but we're closely monitoring and may add positions when opportunity arises.
Okay, so let's switch to maturity dates of bonds, which can sometimes be confusing. Investor statements sometimes show a bond that appears to have a very long maturity that ends up not being so long. So can you help us understand why that happens?
So unfortunately, given the complexity and the structure of many of these bonds, it's often hard for a client's statement to fully describe the various characteristics of a bond, including call dates and early tender dates. There are many bonds with maturities that look like they are due in 20 to 30 years, but will in fact be paid off at a much shorter date. The most common bonds with longer apparent maturities are bonds with call features, bonds with weekly floating rate put options, and bonds with put, or also known as mandatory tender bonds. Let's take a look at a mandatory tender bond as an example. So the tender date is not clearly shown on most security descriptions. So let's look at this Grand Parkway Texas Toll Revenue Bond as an example. The bond has a stated maturity date of 2052, 29 years from now. You'll see that right smack top middle circled in the red. However, you will note that on the right-hand side, also circled in red, there is a next mandatory put that says 10/1/23. So this bond will actually be paid off this year. That long and final of 2052 allows the issuer to use some bond indenture, which is just a legal issuance, but remarket that bond at a mandatory tender date. This provides the issuer with a long-standing legal issuance, but with short-term bond characteristics, which more closely meet the financing issues, the financing needs of that borrower.
Thanks, Carlton. I'm going to pose some additional questions that were sent in by clients ahead of today. We've received a few about cash positions, and you've already described that the most client cash is held in the BlackRock Liquidity Fed Fund. Can you please speak to why cash positions and client accounts fluctuate? Craig, this one's for you.
In a nutshell, cash is typically a tactical decision within a larger strategic allocation. So at the beginning, we talked about the volatility of interest rates. Sometimes we're in a more attractive rate environment than other times. We're in a more attractive environment right now. If we believe rates will be moving higher, we are less aggressive in buying bonds. We want to wait for better rates, hold cash. Sometimes the best decision is to hold tight and not buy bonds.
Okay, thanks, Craig. Again, on client statements, one can see the changes in individual bond values. Can you explain how these changes in bond prices should be viewed by the owner?
And given the volatility we've seen, this is an important question, especially with last year's weakness. We focus on buying individual bonds for a very good reason. Mutual funds and exchange traded funds have no set maturity date, no final maturity value, and are subject to volatility caused by other investors moving monies in and out of funds. With individual bonds, each client has their own closed box of investments. Their bonds are their bonds. By buying individual bonds, each client earns the embedded yield on their bond holding and get its value at maturity. And if they choose, they can ignore the market price fluctuation. I think we have a good graphic here to hopefully explain this. So let's see if this helps. The example below illustrates why a buy and hold investor can look past interest rate volatility and just focus on the total return. In this case, an investor buys a $100,000 bond. That's the face value. It pays a 3% annual coupon maturing in just 2 years. So it's a 2-year bond, 3% per year. We understand and accept, though, that market rates will move after a bond is purchased. So in the first scenario on the top, if rates rise by 200 basis points or 2% after the bond is purchased, we've said that when rates go up, prices go down, the bond price falls by $2,000 in the first year. So that $100,000 value would look like $98,000 a year later on the statement. But the $3,000 income earned cushions that price decline. So the investor has, in the middle of the page there, a 1% total return for the first year. Because the issuer redeems the bond at par, though, in the second year, the bond price regains the $2,000 lost in the first year, and the bond pays out another $3,000 in income for a higher return in the second year of $5,000 or 5%. So net, it's over the 2 full years from purchase to redemption, regardless of the volatility. The 2-year total return is the $6,000 or 6%, 3% per year. The $2,000 market value decline in the first year has no effect on the bond's total return. And in scenario 2 below, people aren't usually as upset in a declining rate scenario where bond prices go up. But in the end, it's the same. The bond still has a total return of 6% or 3% per year. So whether rates move up or down for the buy and hold investor, unrealized price gains or losses from interest rate changes are reversed when bonds are redeemed at par, and the total return on the bond held to maturity is equal to its purchase yield.
Okay, we've received what I thought was a pretty interesting question that came in that pertains to unique or unexpected statistics or graphs or resources that you turn to for insight about bonds or the economy. Would each of you answer this one, please?
Mine's a little boring. I think it's actually not that unique anymore, but I still find it fascinating. This is the Castle system. So everybody knows the swipes entry into building Castle. This is the back to work barometer. So this barometer and this shows the actual office entry swipes in major US markets. So how much and where are people returning to offices? So I like it for a couple of reasons. It's somewhat an indicator still of the reopening strength of the economy, which I think is still very important. And since we buy a lot of municipal bonds, we can look at this broken down by city. So since many cities are dependent on the level of business activity in a downtown area, it can be a helpful indicator for us to get a sense of the municipal balance sheet strength. And it's important since we own a lot of municipals.
And so my chart, which actually has become probably a little bit more important in the last couple of weeks, it's called the Fed Senior Loan Officer Survey. It's basically a poll to gauge how easy or tight lending standards are. So easy standards indicate a business can easily take out a loan, and tight standards indicate that the underwriting process is going to be more arduous. Interesting, we see that lending standards are the toughest in the middle of a recession, not before. The situation is also interesting now because standards are very tight, but we have yet to realize a recession. And these standards are really tightening long before the SVB collapse. Either lenders have learned their lesson or there's a big disconnect between what they're seeing and how the economy is currently behaving.
We have received a couple of different questions about bond characteristics and in particular duration. So what is duration and what's Chevy Chase Trust's perspective on duration?
Many clients confuse duration and maturity, and they're similar, but they're not the same. Duration is essentially a measure of interest rate risk. So when measuring risk, it considers the interest payments and maturity of each bond. So it considers the cash that you receive back. Those payments that you earn as an investor, they reduce your risk. So in its simplest explanation, if you think of a zero coupon bond, so a bond that pays you no interest, but gives you your principal back at a higher level in 5 years, a 5-year zero coupon bond has a 5-year duration. Duration equals maturity, in that case with no payments. But a coupon bond where you receive money will have a duration that's shorter than 5 years. And the higher the coupon, the more cash you get back, the less duration risk you're taking. So we put together a slide here, which I hope is helpful. So in this example, we used a real wide variation. We used a 1% bond and an 8% bond. Couldn't be more different. So in this example, you'll see that on the bottom, the 8% coupon bond. So if you got $80 per year on a $1,000 bond, that reduces your risk and it essentially reduces the bond's duration. So the duration of a 5-year bond with an 8% coupon is that circled red 4.1 year duration. Okay, so 4.1 year duration for an 8% coupon. Above, you'll see the 1% coupon, which is not a lot of cash back, has a 4.8 year duration, very close to the 5-year maturity. So we know the role of fixed income. I've said this 10,000 times: preserve principal, stay ahead of inflation while taking appropriate risk. We don't expect clients to get rich on bonds. Typically greater risk and rewards are seen in equities, but we think we can be smart about buying bonds for principal protection while adding value and return, and adjusting duration as part of that strategy. So we'll adjust duration based on interest environments. Our current strategy is targeting durations in the 3 to 4 year range. So if this was the early 80s, late 70s with hyperinflation and long-term rates at 16+%, I like to think that we would have been smart enough to buy 30-year bonds. But that's not the world we are in now or have been in recently. Only recently in the last year, have we seen a real return to some levels. Generally, we do believe that a short intermediate duration strategy is appropriate for our clients. have bonds mature on a regular basis for reinvestment. And this allows us to capture much of the yield of longer duration securities with less risk. And we've actually studied the past 50 years of interest rates. And we compared an intermediate treasury, which had a less than a 4-year duration, similar to where we are, with a treasury index that had a greater than 6-year duration. And in that review, the shorter duration bond portfolio strategy delivered 95% of the return of the longer duration bond, but only had 60% of the duration risk and 93% of the volatility. So we're executing a strategy that we believe and has shown you can get nearly all of the return with just about half of the duration risk.
Thanks, Craig. Okay, Carlton, this one's for you. What are I bonds and when should they be purchased?
So for those of you that don't know about I bonds, they are U.S. Treasury bonds, which pay you a rate of inflation calculated semi-annually plus a small fixed rate. But there's a catch. They can only be bought at a maximum amount of $10,000 per investor and an additional $5,000 as part of a tax refund. So the reality is, for our clients who are wealthier, it's really a drop in the bucket for their investment return. Remember though, we discussed TIPS earlier and real yields. TIPS and I bonds both adjust with inflation. And here at Chevy Chase Trust, we can buy large amounts of TIPS. The I bond rate is currently 6.89% and has been falling as CPI has declined. And honestly, it will be likely to continue to fall.
Thanks, Carlton. Okay, we're coming up on the end of our program. We have one more question that we're going to address. Our final question was submitted by a Maryland resident. He notes that his bond portfolio is only about 40% Maryland municipals and asks why you have bought the municipal bonds of other states for him. Carlton, will you go ahead and take this one, please?
Yeah, absolutely. For a variety of reasons, and this applies to clients who see bonds in their portfolios that are from states other than their state of income. In this example, we're going to talk about Maryland. With a 10% state income tax rate, Maryland municipal bonds are in high demand, typically are a bit expensive. Higher price means lower yield. Maryland residents think that they need to buy Maryland bonds. They push those prices higher. In states such as Florida, Washington, and Texas, and other states that have no or low state tax rates. So those bonds have no built-in demand, and they typically trade at lower prices, which means higher yields than other bonds. So looking beyond Maryland also allows us to look for cheap bonds in 50 states instead of just one state. So in this example, for the Maryland resident, we can buy bonds from other states, pay that Maryland tax, and still receive a higher yield than just buying that Maryland bond. We have now constructed a more diversified portfolio. Maryland is a great state, but we don't want all of the portfolio risk concentrated in just one socioeconomic geographic area.
Thanks, Carlton. And thank you, Craig, for taking this time to clarify and explain thoroughly all of these topics today. You both have covered a lot of ground here. We appreciate your efforts. Thanks too to all of you who joined us for today's program. We hope this helped with your understanding of fixed income investing, inflation, interest rates, and the Fed. We know how busy you are, and we appreciate your taking the time to spend this hour with us. This program has been recorded, so if you're interested in revisiting any of these topics, the recording will be posted on our client portal, Wealth Access, and our website. So thank you again, and we look forward to seeing you the next time.